Hey friends, welcome to today's session titled Path to Achieve Financial Freedom. Of course, if we are able to invest wisely, we can live well for the future. With that said, I'm Leander Ataid, an AMFI registered mutual funds distributor, and also I've been certified by the National Stock Exchange NSE by successfully completing their technical analyst course. So without any further ado, let's just begin. So the purpose of today's session is to understand the various opportunities wherein you can invest your hard-earned money, of course with ways to reduce potential risks and try and achieve high growth. So first off, these are the different investing opportunities which we can look at. First being the bank FD. We have a rate of return, a rate of interest, ROI, which is a year-on-year calculation, the risk involved, and the taxation. So for the bank FD, which is a very popular investing opportunity, the rate of return varies usually from 5 to 7%. At this time, it's around 7.45%. The risk involved is rather low, unless, of course, the bank or institute you invest with goes bust or goes bankrupt. In that case, you have a cover of around 5 lakhs, but above that, it'll be pretty difficult for you to get your money. Taxation wise, the interest what you earn on the FDs are taxable as per your tax slab. Whatever tax slab it may be, 10, 20, 30% as per your income tax slab, you'll be taxed based on that. Next up, we have the equity mutual fund. It's a fund which invests directly into the stock market. It buys shares of various companies. If you see the long-term horizon, 10 years plus, equity mutual funds have given you very good returns, well over 14%, at least most of them. Risk-wise, it's pretty high because of the market volatility, wherein we have instances like the COVID time where the markets dropped around 35%. Then we had the dot-com bubble, we had the Lehman Brothers housing crash, we had the Herschel Mehta scam, we had the Ketan Parekh scam, so on and so forth. A lot of instances wherein the stock markets corrected by a large amount. However, it's important to note that every time the markets fell, it rose back up not only to its original level but much higher than that previous level. So yes, in the long term, equity mutual funds have definitely given you very good growth. So people who have had patience have been really rewarded. Taxation wise, it's like this. If you invest for less than 1 year, then on whatever profits you earn, you have to pay 15% tax. And if you invest for more than 1 year, on the profits you earn, which is above 1 lakh, you have to pay around 10%. That's only if you sell the mutual fund, of course. Next up, we have the debt mutual fund, or in simple words, bonds. These are of two types, broadly classified. One would be the corporate bond and one would be the government securities. What are bonds? In a very simple language, bonds is an instrument wherein you lend out money to corporates, be it a big company like Tata's or Reliance, or you can give or lend money to the government wherein they use that money for infrastructure projects, etc., and they pay an interest on that. So the average interest rate is around 5 to 7%. The risk involved is like this. There are two types of risks in bond primarily. One being the credit risk, wherein there is a risk that if you lend money to an entity, say a corporate entity, and that company goes bankrupt, then you stand a chance of losing your money. The second risk is something called the interest rate risk, wherein when the bank interest rates rise, the value of the bond or the interest generated by the bond decreases. Now, at this very moment, The interest rates have risen from around 5% to 7.5% approximately. The chances of them going up further from here is rather less as compared to the chances of them coming down. So as the interest rates come down, the value or the interest that the bond generate will definitely go up, keeping at least a 3-year horizon. The taxation, this is a little bit interesting. It's like this: if you invest for more than 3 years, there's something called an indexation benefit what you get, wherein the inflation of all those years you've invested is taken into consideration to calculate your actual investing cost price, you can say. So if you're in a higher tax slab, say 20-30%, you end up saving much more tax as compared to that tax what you'd pay in a bank FD. So that's how the bond market works with the indexation benefit. Next, we have something called a hybrid fund. A hybrid fund is a mutual fund which invests partially in equity or the stock markets and partially in bonds or the money market. Money market is a concept which I'll explain soon. Depending on where more amount of your money has gone in, whether it's gone in the equity or the stock markets or the bonds, we can term the hybrid funds as equity based hybrid fund or debt based hybrid fund. The rate of interest or rate of returns is better than a pure debt mutual fund but lesser than an equity mutual fund. Risk wise, your risk would be slightly higher than a debt based mutual fund but much lesser than an equity based mutual fund. So it's as simple as this: the more potential gains, obviously the higher the risk. Taxation wise, it's similar to equity or debt mutual funds depending on where major allocation or more money of yours has been invested. Next, we have something called ULIP, which is a product or an instrument which is sold predominantly by insurance companies. So this is an instrument wherein you get growth and also you get a partial life cover. The rate of interest varies about 7 to 10, maybe probably 11% in some cases, depending on where the money is invested, because that same money is invested in the bond market, in money market, as well as equity. So depending on how it is invested, your returns may vary a little bit. Taxation is about 10% on the profits after 1 year because you're investing in equity to a large extent. Next, we have insurance products or guaranteed money back plans. This is a instrument wherein you pay for a fixed number of years and then for a much larger time period you get paid every year. The rate of interest in this is comparatively lesser, however you get life cover in this. Risk wise it's pretty low because it's a guaranteed product. Taxation wise, as of now there's no tax on the premiums paid, but as per the recent budget, from next financial year all premiums which are above 5 lakhs per annum combined per person will be taxable. So breaking them down one by one, mutual funds. So what's a mutual fund? A mutual fund is an instrument or a fund wherein multiple people or multiple entities invest the money. You have something called a fund manager who decides where that money gets invested, and whatever returns are generated from there is divided or given back to the investors. The objective of what that fund aims at doing and what is the risk level involved is clearly outlined in something called a prospectus. The prospectus gives you detailed guidelines as to where the money of the fund can be invested and cannot be invested. For example, if it's an equity based mutual fund, the fund manager has to invest that money in the share market. If it's a debt based mutual fund, he has to invest it in bonds. He cannot take the money and put it in the share market. That sort of thing. So it's clearly mentioned so the investor clearly knows as to where his money is going. A mutual fund is known as an open-ended investment fund. Why? Because it's like this: as soon as you buy the mutual fund or you buy units of the mutual fund, once it's credited to your account, you can sell it at any point in time, no questions asked. Of course, the taxation would vary depending on how long you hold it for and what is the profit you've earned from it. A simple representation where you have your investors who invest their money with the fund manager. The fund manager decides as to where to invest that money, whether it's the stock market, bond market, or money market, or some other instruments like commodities and all. And whatever profits are generated from there are returned back or divided back to the investors. So what are the benefits of purchasing a mutual fund? First of all, you get professional management. What does this mean? It means that the person who is managing the fund is an experienced person in the financial field. They have to do a lot of analysis by understanding the profit and loss, the balance sheets of the company, what the company is actually doing. They have to go to the company to see what the management has in mind, what plan they have for expansion. They have to decide whether that's in line with what they are intending to do, and so on and so forth. So it takes a lot of hard work to actually choose particular stocks to add to a particular fund. So yes, the hard work is done by the fund managers, and you get to relax while your money grows. Diversification. What this means is as simple as this: if you put all your money in one instrument and say that instrument does not do well, your money might not grow that much. But if you put it in multiple instruments, some might do well, some might not do well, but on an average, your money grows much faster. So diversification is a process wherein you put in multiple assets like probably real estate, gold, stock markets, debt market, money market. You spread it out. So by doing this, you are reducing the risk factor and also keeping in mind you want growth. Next, we have liquidity. As mentioned, mutual funds can be sold at any time, and it's a pretty easy process in today's world. And then we have flexibility. What this means is this: if you want to buy a property or invest in real estate, you need a large amount of money, a few lakhs, probably a few crores. Many people don't have that kind of money. If you want to buy gold, even to buy 1 gram of gold, you need to invest a few thousands of rupees. Whereas in mutual funds, you can invest a small amount, even 100 200 rupees in one fund at one time. So that allows an investor, even with a small amount of capital, to buy various funds and thus diversify their money. So it's pretty flexible. So what are the different types of funds one person can buy? Major asset classes. First is money market fund, bond market fund, balance fund, dividend yield funds, equity funds, and specialty funds, broadly classified. We'll take this one by one. So money market fund is basically a fund which invests for a short period of time, a few days, probably a few months. Now the returns in this is relatively low. However, it's much more safer. If you want to take an example, say you lend money to a person you know for 5 days, and they say, I'm going to give you this money in 5 days. You know for a fact that he's going to return the money in 5 days, or at least probably 2 days extra, a week's time. So your risk is much lesser because you don't have to wait for years to get your money back. You can get it in quick in a very short period of time. So with that said, your interest or your risk first of all is less. So obviously the interest you would charge him is not too high. Examples of money market are treasury bills, bankers acceptance, etc. Of course, the returns what you get here are not fixed like FDs. but the risks are low. So if you want to consider it with another product, you can say it's like a savings account. We usually, we as advisors, we would keep money in a money market fund temporarily, to invest it systematically into the stock markets probably or debt market. Bond market or bond fund is a fund which invests in corporate or government securities. The term for this is relatively higher compared to a money market fund. So, you're lending money to a corporate organization or the government itself. Of course, the fund or the corporate entity which you're investing or you're lending it to is rated by institutions like CRISIL, wherein they decide whether you lending it to a particular entity, how safe it is, how safe your money is. These ratings vary. It's like B, double B, you have A, double A, triple A plus, etc. The higher A and higher than that indicates to you how safe that lending process is. These are a few examples of your bonds and money market funds, corporates, treasury bills, etc. A balanced fund. A balanced fund is like a hybrid fund wherein part of your money is invested in the stock markets or equity mutual funds, and some of it is invested in bonds and treasury bills or money market. Now, the intention of this fund is to not only look for high growth but also to look for safety. So, in case the markets come down in a few years, probably this fund will not get affected that much. However, when the markets go up, this fund will not grow as much as a pure equity mutual fund. But yeah, this is for more of a stable sort of investing technique. You would invest in a balanced advantage fund. I'll explain to you the returns generated by balanced advantage fund a bit later. So, a few facts about balanced advantage funds. They invest in the stock market as well as bond market. The proportion, of course, would vary depending on the guidelines of the prospectus and depending on the fund manager. So they generate income along with capital appreciation, of course. The yields are higher than a pure bond fund or pure debt fund, but of course lesser than a pure equity fund in the long run. But the risk is of course lesser than an equity fund and slightly more than a pure debt fund. So this sort of fund rebalances investor's portfolio especially when the markets drop down or in a bearish market like we call it. An equity fund. There are different types of funds. Equity fund, like I mentioned, is a fund where you put in money primarily in the stock markets. Of course, the types of funds are diversified funds, sector specific funds, index funds, mid cap or middle capitalization funds, international funds, and other types of funds. So diversified funds are funds like a flexi cap fund wherein you would invest in strong companies or blue chips, slightly smaller or middle sized companies called mid caps, and slightly smaller companies called small caps. The intention of this is diversification on its own, because the big companies, although they are stable, they do not move too much in both directions, of course. The mid cap companies, when the markets go up, they really they grow at a faster pace. Similarly, the small cap companies would actually run when the markets go up, but when the markets come down, also they would fall to a higher extent. Sector specific funds are those funds which invest in a particular sector. For example, if the fund manager feels that the pharma sector is going to do well in the coming few years, they may look to put in the pharma sector. There are funds which invest purely in the IT sector or the automobile sector. So, you're investing in just one sector or the telecom sector, that sort of fund. An index fund is a fund which invests directly into Nifty 50, Nifty 100, or top 50 stocks in the stock market, top 100 stocks in the stock market, so on and so forth. The returns would be in line with the market growth on its own. Mid cap or middle capitalization fund is a fund consisting of medium-sized companies. Growth wise is higher when the markets go up, but of course the risk factor is also higher because when the markets come down, these funds tend to fall down to a high extent. International equity funds are those funds wherein you would be investing in foreign companies or overseas companies, like you say. Say the fund manager feels that the US market is going to do well or the European market is going to do well. They would look to invest in those companies like Apple, Google, perhaps Tesla, and so on and so forth. Others would be like large cap, investing in the big companies. You have thematic funds investing in a particular theme, etc. So what are specialty funds? Specialty funds are those funds which invest either in a particular sector or a particular geographic region and so on. What does this mean? If, say, the fund manager feels that the telecom sector is going to do well, the government policies are supporting the telecom sector, then they would look to invest in the telecom sector, to look for high growth. Similarly, if they see that, okay, Africa is going to do well in the future, they'll invest in companies in Africa based on geographic region, something of that sort. Of course, when you invest in specialty funds, the diversification is rather less, so of course your risk factor can increase. You have to be pretty sure and confident in the concept of what you're investing in. So what are the different investing styles that the fund manager has? First of all, there are fund managers who look for value. When you say value, they look to buy stocks whose price is lower than the book value or available at a huge discounted rate. The issue with this is you need to find these stocks at the right time at the right price, because when someone notices that a particular company is available at a discounted rate, it doesn't take them much time to jump in and buy that stock. So it is a very conservative approach. You have to have a lot of patience in this. Next is a growth approach or growth oriented approach, wherein a fund manager buys stocks which are expected to have a high growth rate in the coming few months or years. The investment is usually put in smaller sized companies or medium sized companies for the simple reason that if you have a company which is priced at 2000 rupees, the time it would take to go from 2000 to 4000 rupees is rather large as compared to a company which is priced at 50 rupees. So the time a company which is priced at 50 rupees would go to 100 rupees would be relatively lesser, considering both the companies are doing well. Sort of that sort of mentality. Of course, the risk here is pretty high because you are putting in smaller size companies which can get hit badly if the markets come down. Next is something called momentum or sector rotation sort of investing, wherein you would invest in a particular sector or rotate the funds or invest in stocks which are having high momentum, thus trying to achieve a higher growth potential in a shorter span of time. Again, risk factor is rather high here. A fun fact about mutual funds in India: the AUM or the asset under management or the size of the mutual fund industry in India has grown from about 7.6 trillion in 2012 to about 39.89 trillion in 2022. That's around 5 times or 500% in a span of 10 years. And in the last 5 years, if you go to see, from 2017 to 2022, it has gone up from 21.27 to around 39.89, almost double in a span of 5 years, of course. Facts about the mutual fund industry: there has been a huge growth in the past 6 years, and yes, this growth is expected to continue. An interesting thing to note is that we as Indians have a high rate of saving money. We look to save money for the future, not knowing what the future holds. But yes, we plan for the future to a large extent. Now, what is important is to channel this investments or this money into opportunities which give you higher growth potential. Next, we have that the cities, if you see city wise, metro cities, people from metro cities would usually invest broadly in the stock markets or into the equity based mutual funds because they were well aware of the opportunities. But today, smaller cities, urban, semi urban, rural areas are also understanding these concepts and they are more confident in putting their money in mutual funds. So, thus, again, supporting the claim that mutual fund industry is going to grow rapidly in the coming few years. Also, SEBI, the regulatory body, is allowing mutual funds to invest in commodities like gold, silver, utility based metals like copper, lead, aluminium, nickel, zinc, etc. And also in products like what do you call that, cotton, etc. Those kind of products. Emphasis on better corporate governance. You might have watched the video of PP water balls, wherein the price of a company was artificially inflated, and thus a lot of investors got trapped in that. Similar thing happened in the case of ACC Cements in time of Harshad Mehta, and as per reports of Hindenburg, or I would say allegations against Gautam Adani's companies, wherein they were alleged to artificially increase the price of their stock. So to avoid all these sort of things, a lot of emphasis is given to have corporate governance which is favorable or supporting the investor. And of course, in today's world post COVID, a lot of people have updated themselves, learned about finances, learned about financial opportunities for investing, and thus are able to educate others on the need based services sort of thing, so that you have a better idea as to where and what your money is doing. This is something that I personally use: asset allocation. Depending on what the investor is looking for, what is the investment amount, whether it's a lump sum amount or an SIP like monthly or weekly installations, and depending on the time horizon, we can model your portfolio to consider the factor of reducing risk and also keeping that you're looking for a higher growth percentage, right? So blue chips, more stable companies would have a higher allocation than mid caps, then small caps, by size of the companies. Debt funds also I look to invest in because it's a more stable product. In case the markets drop down in a few years, your portfolio will not be hit that much. And of course, I always choose to keep something called an emergency fund or cash reserves. In case the markets drop by a large extent in a short span of time, we can always invest that money in. Or if you need that money for any other purposes, which is like an emergency, you always have ready funds in hand. This is a small calculation. If you had done an SIP of around 5,000 rupees for 20 years, that's 5,000 rupees a month, with interest rate of or growth rate of around 12% year on year, you would end up investing 12 lakhs at the end of 20 years, and you would end up getting around 49 point or 50 lakhs approximately as your total value at the end of 20 years. Now I want to show you what just 4%, how 4% makes a difference. In this case, you're expecting a return of 12%. In this case, you're expecting a return of 16%. The amount is the same, investing amount is the same, time period is the same, but in the first case, you were getting around 50 lakhs. In this case, you're getting around 87.5 lakhs. What's the difference? Just 4% increase year on year. And another important thing to note, what happens if you invest for a higher period of time? Say in this case we were investing for 20 years. Let's take the condition where we are investing for 25 years. Amount is the same, expected rate of return is the same, just the difference is the time interval is higher, your money potentially doubles. The same way, inversely, if you think of it, if you invest 5 years later, then your net value, considering the same interest rate and the same amount, your net value at the end would be potentially half. So it's very important to start investing early. Whatever amount it may be, that does not really matter as such, but make the habit of investing, inculcate that, so that you can build a very decent sized portfolio in the future. That's a very important thing to do. With that said, you must be wondering, I'm showing you 16% rate of return. It's pretty high. How can I consider such kind of things? So for that, I will be showing you what mutual funds, top 3 mutual funds in India, that's the SBI, HDFC mutual fund and ICICI Prudential mutual fund, have actually delivered in the past few years. This is an HDFC flexi cap fund which consists of large cap or strong stable companies. A portion of it is in mid cap or mid sized companies, and a portion of that in small cap or small sized companies. If you see the third row here, in 1 year it has delivered around 21%, 3 years around 28%, 5 years 19.5%, for 10 years around 15.5%, and since inception approximately 1994-95 it has delivered around 20 odd percent. So the longer horizon, your value gets increased to a large extent. So it's important to keep your investment in there for a longer horizon so that your money grows while you sleep. This is the SBI large and mid cap fund. As you can see this column here, from 1 year to 10 years. In 10 years, a larger horizon it has given you approximately 15.5%. Next, we have the large and mid cap fund of HDFC mutual funds. As you can see, the returns here since inception is around 13.5%, 10 years odd is 14.2%, and so on. Of course, this fund is a more conservative fund, so the returns from this would not be as much as a more aggressive fund. Of course, safety factor in this case would be higher. This is your ICICI Prudential small cap fund. As you can see, the returns are in this column here. If you take a 10-year horizon, around 16.5% has given you. Pretty decent. This is a HDFC Balanced Advantage Fund. The reason I've taken this fund is I personally like it, even for a conservative investor, because it has around 67% equity and the rest is invested in the bond market as well as the money market. So when the mutual fund does, or when the stock market does well, this fund really grows. And if the stock market falls, the bond portion and the money market portion of it protects you from taking a hit. Returns are here. If you see the 10-year horizon, it's around 14.2%, which again is pretty decent for a conservative fund. So this is something I personally do of how to formulate a person's portfolio. First of all, I have to understand how much amount a person is putting, whether it's a lump sum or an SIP, what is the time horizon, what is the risk a person is ready to take, whether he's ready to play the market's volatility or he wants to play a very safe game. Depending on that, a calculation of what I've done, a person investing around 32 lakhs. This person did not want to take too much of risk. He was happy with returns which are better than FDs. So what did I do? I put 30% approximately in government securities or bonds. Why did I do this? Because I am expecting the bond market to grow at a high pace in the next 3 years. That's when the interest rates, bank interest rates, come down. Again, I use the conservative method of using a balanced advantage fund, wherein I am doing an SIP which is going to be running for the next 1 year. Some portion in a flexi cap fund. Instead of putting in a large cap fund or a blue chip company, I'm putting in a flexi cap fund because it is more aggressive. A smaller portion in the mid cap and a even smaller portion in the small cap. And also I've offered him the dividend yield fund, wherein this fund invests in companies which give you high dividends or pay the investor high dividends. So even if the stock markets do not grow very rapidly, you're safer because you're getting dividends paid, so the fund value is definitely growing. And of course, I've kept a cash reserve of around 5.8 lakhs here, which can be used as an emergency fund, or if the markets drop drastically in a short span of time, I always have the option of putting this money inside. So this is the way I would formulate or model an investor's portfolio depending on what he or she is looking for. And of course, I gave them a detailed summary of what the particular investment is intending to do, what is the risk involved, what is the expected rate of return, etc. So the investor also gets a clear-cut idea of what his money is going to be doing and what he or she can expect from the investment. Now, one very important aspect as to why India is expected to grow rapidly for the next 10 to 12 years at least. Logically speaking, let's take the case of US in comparison with India. In India, a person who is not earning a very high income would not look to invest in a property or real estate and pay their housing loan when the income is not really supporting to pay those EMIs. Leave aside property, they would not look to buy a car, a high-ended car, if the income is not really supporting. Forget a car, they will not even invest in something like an iPhone 14 Pro because the income source they know is not supporting, if at all. Whereas in the US, money is lent out, in a very disorderly fashion, wherein people who cannot afford take loans or take EMIs, buy products on EMIs, and end up defaulting to a large extent. So that's a very logical reason why we see that India is going to grow, because India, the way we invest or the way we spend our money is in a much more rational way. So yeah, that's a very healthy method of growing. Another thing to be considered is the China plus one concept, wherein a few years ago most of the developed countries were considering China to invest in or to set up industries. In 2010, China came up with a one-child policy. With that, the working population of China, or the average working age, increased. That means the young population decreased and the older population increased. So labor started becoming a problem. Secondly, with COVID, the developed countries of the world realize that depending on one particular nation is not the best of ideas. So they're looking for other avenues to start investing. So let's consider all the geographical regions. Southeast Asia is one of the places they're considering. However, Southeast Asia is affected by natural calamities to a large extent, be it tsunamis, earthquakes, etc. The location is not very favorable for investments, although they have rather large populations. If you see the Eastern European nations, they're war stricken right now, so it's pretty difficult to do anything there. Look at Africa, again war stricken, and of course they have people, they have land, they have resources, but it's in a very disorderly fashion. So putting in money there could be risky. Looking at Pakistan, They are in economic turmoil right now. So also Sri Lanka. Looking at Australia, logistics pretty expensive. The economic policies are not the best in terms of investing wise. Looking at South America, yes, of course, this is one avenue that countries would look to invest, because especially Mexico with the proximity to the US. However, these countries are hit by the drug cartel and the drug wars, so it's pretty risky to invest there. So if you see the entire world, Middle East, of course, investing there is pretty expensive. Leaves us with India because they're looking to move out from China. India has resources. India has a very intelligent population. We have good manpower. The policies, economic policies are very favorable for foreign companies coming in. So yes, India is expected to grow at a rapid pace in the coming few years. If you're not investing at this time, I suggest you really consider starting, because the game has changed now. The game is no longer to retire at the age of 60. The retirement age has been brought down drastically. People are looking to retire by the age of 50, 47, even 45, or even lesser than that. So, the plan is pretty simple: to work while you're young, invest, grow your money fast, retire early, and enjoy the rest of your life. Be it foreign trips, be it buying your holiday home, and so on and so forth, whatever it may be. So if you're not investing right now, please do consider investing. If at all you need any help, any advice, you have any queries, please feel free to contact me. This is my visiting card. I am certified by the NSE in technical analysis actually. I am an AMFI registered mutual funds distributor, and also I'm certified by the IRDA to advise investors or customers when it comes to term insurance. So if you're looking to grow your wealth, planning for your future, planning for your retirement, planning for your children's education, planning for tax saving, whatever it may be, please feel free to contact me. My number is noted down here, as well as my email ID. I'll be more than happy to assist you with your investing journey. With that said, I'd like to take your leave. Stay safe and God bless.